Well, thanks for watching another video. So if you're a W-2 employee and you ever thought about how you can save more on taxes when you're doing your personal return, in this video I'm going to cover 6 areas that you can kind of think about as we kind of near 2023 on ways and how you to reduce your taxable income. I'm going to go through the 6 items and then I'm going to show you a tax return that shows the tax impacts on these savings. So if you have any questions, let me know. And again, as always, owning a business is probably the best way to save on taxes. There's a lot of opportunity there, but unfortunately for W-2 employees, there's only so much you can do. But in this video, I'll cover kind of the main ones that most of you have kind of heard about. Thanks again for watching. Okay, welcome. So I'm going to go through 6 slides here with 6 tax saving opportunities for those that get a W-2. And then at the end, I'm going to show you a quick tax return on how these tax savings kind of are reflected in a tax return. As I stated earlier, the best tax saving opportunity is owning your own business. There's a lot of opportunity to save on taxes, but if you're a W-2 employee and you're watching this, there's only so much you can do. So I'm going to cover 6 items here. These are pretty common, but I do see a lot of people miss these opportunities. So the first one is 401k retirement plans. Most businesses out there offer this. And as I work on, individual tax returns, I see this missed a lot where employees have an opportunity to kind of max out their 401k contributions. And in 2023, that amounts $22,500. If you're over 50, you got to catch up. You can contribute up to $30,000. And again, this is pre-tax. So just say you make, $200,000 a year, instead of paying tax on the $200,000, you're going to be paying tax on $200,000 less this. This amount that you're going to contribute is going to go in a retirement account. And then when you withdraw it upon retirement, that's when you're going to get taxed on it. So it's kind of like a pre-tax savings, meaning that you're going to be paying tax and less tax on your earnings for the year. But it's big, right? So it's $22,500 that you're going to be saving here. And on your W-2, and this is where I see it a lot because I don't know if people contribute or not, but in the W-2 that you get at the end of the year, it's box 12D. And I often see either amounts in here that are a lot less than $22,500 or there's nothing in here. So this is kind of like a no-brainer. I would max it out. And a lot of companies also offer kind of like a matching program. So that's the 401k. Next up is the health savings account, also known as HSA. I almost think this is sometimes better than the 401k, but, what this is you're contributing money pre-tax to a health savings account. And the beauty of it is it grows tax-free. You don't have to use the amount in that year. So if you're a family and you have a high deductible plan, and by the way, I have another video that covers HSAs, but it's got to be a high deductible plan. You can put the max in $77.50 if it's a family or single. And this is a deduction. So you get to deduct this on your tax return. It's tax-free, right? So, all the money you put in there is tax-free. It grows tax-free. You take the amount out, you don't have to pay taxes on it. Essentially, you're using it to kind of reimburse yourself for health costs that you spend during the year. Now, the other thing too is just say you spend money in 2023, right, on some health costs, right, $2,000. And you don't have to reimburse yourself in 2023. You can reimburse yourself in, 2024, 2025. But the beauty of this is to kind of keep this growing because as you get older, health costs are going to cost a lot more, and having this lump sum available to kind of pay for those healthcare costs, is going to be a nice added benefit there. Another opportunity here is the Roth IRA, the backdoor. I say backdoor is because your AGI, or adjusted gross income, is capped, meaning that you can contribute directly to a Roth IRA if your AGI is below these amounts. Okay, so if you're married, it's 228. If you're single, it's 153. But if you're over those amounts, you can still contribute to a Roth IRA, but it's through a backdoor approach. I highly recommend don't doing this on your own. I see many people try to do this and they mess up, and it causes a lot more work on the back end before they file their tax returns. So use a financial advisor to kind of set this up for you and just manage it for you. That's what I do personally. But again, once the money is in a Roth IRA, it grows tax-free and you get to take the money out at retirement age and not pay any tax on it. So the key is to kind of build up this Roth IRA account. Now, the contributions that you make to a Roth IRA, they're not deductible because it's post-tax money that you're putting in. But the key is to kind of grow this. And again, it's going to grow tax-free. You get to take it out and don't have to pay taxes on it. Next, charitable donations. So if you're very charitable inclined, and I'll show this to you on the itemized schedule, our family donates a lot to charities, but there's a thing called a donor advised fund where you can put in, just say it's 2023, you put in $50,000, right? You can take that deduction, all $50,000 this year in 2023, but you don't have to put those funds to a dedicated charity in 2023. You can just have it sit there and wait and kind of just, disperse it as you please, but you can take that lump deduction in that 1 year. So that's another nice perk. Next, 529 plans. This is for your kids, for saving for college. You don't get a deduction at the federal level. Some states offer a deduction or even a credit at the state level. So you got to look out for what state you have. But again, the account grows tax-free and you get to take the money out tax-free. So it's not a bad option, but you got to think about that. You don't want to be locked into these 529 plans because just say your kid decides not to go to college, then what happens? And there's been some rules recently where you can kind of convert a portion of that 529 to a Roth if it's been held in a 529 for long enough. But you just got to be careful. And there are other options to set up retirement accounts for your kids, and they can use that money for college. They can use it for other things, to buy their first house, buy a car, whatever. But that's another, tax savings opportunities, the 529 plan. And by the way, at the state level, you're not saving that much. So if you're doing it to save for taxes, you're going to get a little benefit there, in the year that you make the contribution. But the key is it grows tax-free and you get to take the money out tax-free. And then finally, tax loss harvesting. What this means is, just say you got this dog of a stock. It's losing money. You bought it at $5,000 and it's only worth $1,000. What you can do is sell it, get that $1,000, right? You have a loss of $4,000, right? $5,000 you bought it at, you sold it at $1,000. You get to use that loss to offset other gains that you might have. Or if you don't have any other gains, you can use up to $3,000 to reduce other income that you have, like W-2 wages and stuff. But the idea is when you sell it at $1,000, you use that $1,000 to buy another stock, and then hopefully build that up. So here are 6 items. Next up, I'm going to show you a tax return. Thanks. All right, so this is the last part of this video here. I'm going to go through a couple of the 6 items that we talked about and kind of show you what they look like in a tax return. So the first off is the W-2. So if you're a W-2 wage earner, this is what your W-2 might kind of look like. If you go down here in box 12, code D, this kind of shows the whole 401k contribution. So when we work on personal tax returns, I always kind of look at this because I'm curious when someone kind of works at a W-2, if this is blank, or if this is not maxed out. Because what this does is essentially kind of reduce the amount of tax. It reduces your income, right? Because you're contributing to this 401k, so your paycheck is going to be less, which means that you're going to be paying less income tax because your income is a lot less, but you're saving for retirement. So what I encourage you to do, if you have not done so already, is try to max out this 401k. If you're working for an employer, I think all employers offer a 401k. They have matches and all that, and you want to max this out every year. The second thing is the HSA contribution. Okay, so let's go back to page 1 here. Here, this couple, they make their AGI, adjusted gross income, is $232. And at the end of the year, they owe about $2,500. Now, we find out that One of them is going to contribute to their employer's HSA account, or their personal HSA account at their employer. And they're going to max this out, right? So they're going to put in, let's say they're going to put in $7,200, okay? We're going to recalculate this. And like I said, HSA contributions, they are a deduction. They grow tax-free. You can take them out and you don't pay tax on them. You got to use them for, healthcare costs and stuff. But there's like 3 benefits to it. And that's why I think they're almost better than a 401k. But anyways, you can see here how by putting $7,200 away, now what they owe is about, $800. Okay. Remember, this is $2,500. So it's not a dollar for dollar reduction in how much they owe because it's a deduction. It's not a credit. But it reduces their tax liability. So now they have money sitting in this HSA account. They don't have to spend it. I'm going to show you what the tax form is going to look like. It's this 8889 form, okay? And this is in 2022, so the max contribution was $7,300 in 2022. But they put money away, and it's to be used for healthcare costs. In 2022, if they didn't have any healthcare costs to use, they don't have to take the money out. Then next year they put another $7,200 in. So now it's at, almost $14,500. And they may not have anything, but at the same time, it's kind of growing. And as they get older, healthcare costs are going to increase. So it's a nice little bucket to kind of save up for when you get older, where you can kind of, take that money out. And again, when you take the money out and you're using it for healthcare costs, you don't pay tax on it. So, and then another one is the charitable contribution. So, in this example here of this couple, and I did this intentionally, they're taking the standard deduction. So if you go on page 1 of your 1040 here, you go down to line 12, this qualified standard deduction or itemized deduction. In 2022, the standard deduction for married filed joint was $25,900. Okay. And what this does is it reduces your adjusted gross income. So you're trying to get to your taxable income as low as it can. Okay. So remember, they started out at $232,000. Now they're down to $199,000. And they've taken the standard deduction because it's higher than the itemized. So now let's look at the itemized schedule. And the itemized schedule, what this shows is, here's state and local taxes that they paid. Here's their mortgage interest. And the sum of those two is $19,000. And that is lower than the $25,900. So why would they take this? Now you can see here, gifts to charity, right? That's blank because they didn't make any donations. Now you can see the difference between this $19,200 and the $25,900. If they were to make anything above that difference, so anything that pushes this above the $25,900, then they get to use the schedule because it's a higher deduction. And that's where the charitable donations go into play. And if you're charitably inclined, right, there's a lot of people out there. I'm one of them. I like to give a lot of, donations to charities. This is a great way of doing it. And you can also do this donor advised fund. The donor advised fund allows you to create this fund. You can put money in away in a year, right? So just say you put $10,000 away this year, right? But you don't know what charities you want to donate to. You can take the deduction this year, okay? So we're going to put that here. We're going to do a recalculation. And we're going to go back to that form, the itemized schedule. So you got the $9,000 here. You got the $10,000 mortgage interest. And then we've got another $10,000 of charity. Now this is $29,000, okay? This is above the $25,900, the standard deduction. So if we go back to page 1 of their 1040, and you look at the standard itemized, now it's taking the $29,000 because it's higher. And what this does, it lowers their taxable income and they pay less tax, and we go all the way down to the bottom. Now they're in a small refund position. So if you're charitably inclined, you like to give away to charities, you want to look at that difference here, the standard or itemized. And if you have a lot that you can donate, you can set up this donor advised fund. you could put all of it in there, get the benefit this year, the money that, the year that you put the money in, but you don't have to allocate it to the different charities in that year. You can wait next year, 2 years from now, 5 years from now, 10 years from now. But you don't get to take the deduction every year. You only get to do it in the year that you make the contribution to that charity. So that's donor advised funds. If you don't want to do a donor advised funds and you just want to donate every year, that's fine. And you get to take that deduction every year. So that's that. And then the tax loss harvesting. So again, we're going to keep everything as is here. And you see this capital gain or loss, this line number 7 here, it's blank. So let's go back to, let's kind of create a loss here, right? In the example I gave earlier, you bought something at $5,000, let's say Peloton, you sold it at $1,000, right? So you bought it at $5,000, you sold it at $1,000. Peloton's not going anywhere. You bought it 1/1 of 2020, and you sold it this year, 12/31/2022. It's a long term. Okay, so you got this loss. So the whole idea with the tax loss harvesting is you sell it, right? Because it's not going to go back up, right? You kind of just you face the facts. You lost some money here. You take this $1,000 and you buy new stock, right? And you hope that new stock increases. At the same time, you got this loss, right, of $4,000. So here's what happens to that loss. Is on page 1 of your 1040. Here, let's watch this number 7 here. What's going to happen? You get to deduct up to $3,000 every year. Okay, so remember you had a $4,000 loss. You can only deduct up to $3,000 of those losses. So again, further reducing your taxable income, and that $1,000 that you weren't able to use of the $4,000, that gets carried forward to next year. So if you didn't have any losses in 2023, you still get that. So you don't lose it, right? You're just capped at $3,000. So now let's go all the way down to the bottom here. Now they're in a refund position of $700. So there's a lot of, these are just very basic things for W-2 employees. But again, tax planning, you want to start thinking about, there's a lot of different things that you can do to kind of start saving money on taxes. And I see hundreds of tax returns every year, and there's lots of missed opportunities. And the reason why is there's no tax planning being done. So reach out to your CPA, make sure you guys are talking. The good time to start talking is anywhere between now and like the beginning of December, because again, once December 31st hits and it's the new year, there's very little that you can do to make any changes here. So hopefully that helps. If you have any questions, leave them in the comments below. Thanks again for watching.